All right, so this is one of your practice problems. And the key is posted, but I thought I would work this one out anyway because it's pretty fundamental really to this whole course because, the whole point of this course is to be able to look at different types of entities and do kind of an analysis of which entity would you choose to form to operate a business. Okay, so we've got this situation where Tremaine is going to start a business, and he's going to organize either as an S corporation or a C corporation, and it figures he will be able to generate a 9% annual before tax return on $1 million investment. Okay, his marginal income tax rate is 37%. And his tax rate on dividends and capital gains is 23.8%. So he's in the highest tax bracket, and we're accepting that his marginal tax rates at the individual level are at the highest levels. Okay. If he organizes as an S corporation, we're assuming that he'll be able to take the qualified the QBID, okay, the deduction for qualified business income. And we're also going to assume that he's not going to be subject to the net investment income tax because he is an active participant. This is not going to be investment income, okay? We're going to assume that they're going to pay 25% of their after-tax earnings every year as a dividend if it is a C corporation. Okay, so the first question is how much cash after taxes would Tremaine receive from his investment in the first year if it's an S corporation or a C corporation? So we're going to have to run this calculation essentially two ways, okay, and look at how much cash he is going to get after taxes. All right, so I'm going to scroll this up and we'll get to work. Hopefully I've left myself enough space. All right, so the first step is to figure out what the entity's pre-tax earnings are going to be. Okay, and we know that he's expecting a 9% return, and it's $1 million investment. So what does that give us? That's $90,000 of pre-tax earnings, regardless of form of entity. Okay, so let's look at C corporation. All right, so a C corporation's tax rate is 21%. So C corp entity tax equals this $90,000 times 21%, which gives us $18,900 dollars of tax. So after tax is going to be after tax earnings, and so that $7,100 is entity after tax earnings. Okay, so that's what the C corporation has after taxes. Okay, now what do we know is going to will happen? Now, we're also told that if he's organized as a C corporation, the C corporation is going to pay out 25% of its after-tax earnings every year as a dividend if it's a C corporation. All right, so let's come back over here. I'm going to resize some things. We'll see if I've left myself enough space or not. So that is a dividend of $17,775. Okay. And we know that the tax on the dividend is 23.8% times and so that is going to be 40 to 30.45 in owner level taxes. So as a C Corp, after-tax cash is going to be equal to, at the individual level, is going to be equal to 17,775 minus this 42, 30, 45, which is equal to 13,005.95. Okay, so that is at the C corporation level, his after-tax cash. Okay, now we have to do a similar thing for an S corporation, and so I'm going to slide way over so that we can hopefully get that done. All right, I'm changing color so we can tell the difference between the C Corp and the S Corp very easily. All right, so our S Corp earnings at the entity level, so let's call this after tax earnings at entity level are $90,000. Okay? Now, what do we know? We know that there's going to be a QBI deduction, and our QBI deduction is 20% of our qualified business income, and our qualified business income without any other information is just that $90,000. So our QBID is $18,000. So our net income taxable to the owner is 90,000 minus 18,000, which is equal to 72,000. All right, and we're told that his tax rate, so now we got to figure out owner level tax. So the owner level tax is our $72,000 that flows through, taxed at our individual rate. And that is going to be $26,640. So our after-tax cash is going to be that $90,000, right, minus our cash, or excuse me, our taxes. Okay, so that's our after-tax cash if we're an S corporation. All right, now I'm gonna slide it all the way back so we can look at the rest of the problem, because that was just part A. All right, so B asks, what is our overall tax rate on the income in the first year if it's organized as an S corporation or a C corporation? All right, so let's do our C corporation first. Whoops. Let's change back to our C corporation color. All right, so how do we figure out our overall tax rate? Okay, well, our overall tax rate is going to be taxes paid divided by our earnings. So let's look at taxes paid over earnings. Okay, so what taxes were paid? Well, in this situation, we had an entity level tax. Okay, and our entity level tax was $18,900. And we had a owner level tax, right? And our owner level tax paid was $42.30 and 45 cents. And then what were our earnings? Well, our earnings were that $90,000. So that gives us 23, 130, 45 over 90,000. And so that gives us 25.7% if we do just a little bit of rounding. Okay? All right, so now we need to do essentially the same thing at the S Corp level. All right, so S Corp equals taxes paid over earnings. So now we got to figure out all of our taxes paid. So what were our taxes paid at the S Corp level? Well, we didn't have any entity level taxes, so we didn't have to worry about that. We had owner level taxes, right? So that would be, I think that's right. Yep. Okay. Over our same amount of earnings. And that is going to be okay. So, all right, so that's part B. So then C, what is the overall tax rate on the first year of income if it's organized as an S corporation, but the income is not qualified business income? Okay, so if it's not qualified business income, so say they're in one of the service lines that is restricted from using the QBA deduction, okay, then the overall tax rate, oops, is 37% because you don't have a cut for the QBID. It's always going to be equal to then the owner's marginal rate. Okay? All right, so that's part C. And then part D, what is the overall tax rate on income if it's not qualified business income and if Tremaine is a passive investor? So what do we know if it's a passive investor? So passive investor means we have investment income. Okay, we've got this net investment income tax. So we have net investment income, but we're also going to make a couple of assumptions here. Assumptions. Okay, one, income is over the threshold. And it's a reasonable assumption to make because we are at the highest marginal tax rate. So that's a reasonable assumption to make, okay? And we're going to assume that we don't have to worry about that lesser than, okay, clause in the net investment income tax. Remember that net investment income tax right is 3.8% on the lesser of net investment income or AGI in excess of those thresholds. Okay, so we're going to assume that those are met. Okay, so we're assuming that. And if we assume that, what is our overall tax rate? So if we assume all of that, then D is asking what is our overall tax rate on the income if the income is not qualified business income and Tremaine is a passive investor. So then our overall tax rate equals our marginal tax rate plus our net investment tax rate. So our tax rate is 40.8%. Okay. If we were not in the highest bracket, or if we needed to actually do this portion of the calculation, and we might come up with a slightly different answer depending on where this excess ended up. Okay? But we don't have to worry about that for right now. All right, hope that helps y'all.